Again, thank you very much for having me here today and give you a quick insight into the future of real asset investments coming from a family office perspective. My name is Paul. I'm the co-founder and CEO of Finexity AG. I'm originally from Germany. I was brought up and raised both in the UK as well as Germany. And after two small adventures in Asia, in both Bangkok and Singapore, where I briefly worked on a few transactions, I then relocated back to Germany at the end of 2016. I was the assistant of the Global Chief Controlling Officer for a large MNC, mostly working in the M&A space. And then in my last stop, I actually founded a global incubator with my now co-founder, Henning Wagner, where we financed a total of 14 startups, mostly based out of Asia, as well as Europe. And 6 out of those 14 that we financed were actually in this blockchain space, which means that we were one of the really early adopters when it came to understanding the technology behind it and the impact it will have on the financial industry, whether that's the payment space or whether that's the actual financial transaction space when it comes to digitalizing real assets, or in other words, tokenizing them. And this is also how Finexity as a company came about. What we do is that we're actually the first digital family office for retail investors, meaning that we provide them with investment opportunities that usually only are accessible by institutional investors. We were founded in 2018. We're headquartered in Hamburg. We have not correct anymore. We are actually over 30 employees right now. And we have received over 3 million in funding from VCs as well as business angels. But not to dig into too much detail about our company, I just want to give you a quick insight as to how tokenization in itself makes sense and why that really is the best, or like the big next thing in the financial industry. When we're looking at high net worth individuals, so those that have liquid investments for over €1 million, or ultra high net worth individuals with free floating capital of over 30 million, what we can see there is that over 40% of their investments are actually in invested in non-bankable assets or illiquid investments. So we're looking at real estate. Those can either be indirect or direct investments, but we're also looking at private equity and other alternative investments such as art, cars, wine, and so on. The problem with those investments, however, is that they are only really accessible by the top 1%. And the reason is that they are really illiquid, meaning that I don't have the opportunity to get rid of my shares if I own something or real estate within minutes or within days, really. So this is one of the key issues that we face when we're looking at portfolio structures and comparing them, the ultra high net worth individuals with those retail investors. The 4 key reasons that drive the liquidity issue for retail investors is that number 1, it's really capital intensive to invest into real assets. When we're looking at the primary example of Germany and in the real estate market, you usually need around 20% equity to get a mortgage from the bank. If you're a foreign investor, you usually can only maximize your portfolio with a loan to value of around 70%, which means that you need 30% equity plus additional purchase costs, which usually sum up to another 10% additionally on top of the investment required. Another big point is information asymmetries between buyers and sellers. This is something that retail investors significantly struggle with because they don't really have the expertise to value an investment and make sure that it's actually, when it comes to the economic payoffs, makes sense. There's also huge time constraints. The problem being that if I purchase an alternative asset, that's illiquid, I need to usually manage it, meaning that we take the example of real estate again, I need to make sure that it's being rented out, that the rental income comes in, and if that doesn't happen, I have a lot of maintenance issues that might occur and so on. And the last but not least, it's the lack of flexibility, and that's something that blockchain aims to solve by raising more liquidity on an illiquid asset, because I can't have a share of a real estate and then freely trade it on the secondary market. The problem, however, I see with that is that just because blockchain aims to solve that issue and enable fractional ownership, it doesn't necessarily mean that there is a liquid market. So you will still have to implement market maker structures that will actually raise liquidity at first to make sure that people are actually able to trade their fractional stocks and shares. The key advantage, however, is that when we're looking at tokenization, is that through tokenization, we're able to generate fractional ownership parts, meaning that due to the technology or like the technological advantages, we're able to cut down a property into various pieces, thereby make it more accessible. We also raise transparency through the blockchain. So I have the opportunity in my smart contracts to program specific rights and duties, which would then obviously as an asset manager enable me to work really efficient when it comes to paying out dividends, when it comes to making sure that all the taxes have been paid, and so on. Another point is the effortless. So this is more from an investor's perspective, the advantage, where investors are able to 100% digitally through platforms these days, which Finexity is amongst of them, to really digitally invest into an SPV or a real asset, depending upon the capital structures behind it, without any intermediaries. And this is one of the key things that I would dig into at a later stage. And another key point that I just briefly mentioned is actually the tradability, meaning that yes, blockchain enables them to trade their tokens without any intermediaries, thereby cutting costs, thereby making a transaction more feasible. However, as I said, market maker structures will have to be implemented at first. What I find really interesting is that a lot of people that try or reach out to us and say, hey, can we not list something on your platform? Can you give us your technology and how we can do that? They really underestimate that just because we're in the blockchain space, number one, we still have a lot of rules and regulations that we need to comply to. And number two, it's not just the tokenization in itself that's part of the overall digital asset value chain. So it actually, everything starts with a product structuring and the actual issuing of it. We obviously have worst and best practices that we see on the market. Some of them take 9 months until they're being approved, others only 3 months. So this is still something that needs to be decided by the asset manager of how they want to structure their investment, instead of just putting something on the blockchain and trying to sell it. We're also bound by KYC and AML regulations. Thereby, a platform needs to make sure that I actually comply to all of those. And then another key thing is that just because I have an asset and just because I may have the know-how to structure stuff, it's still that I need to distribute my tokens. And distribution is one of the key things in the market. And this is, I believe, there's still a lot of room for improvement when it comes to a lot of platforms, because you obviously need to make it as effortless as possible for the investors. Another key thing to consider is the token programming that usually comes hand in hand with the distribution. So making sure that I have standard protocols that I use. So I'm compliant towards rules and regulations around the market. And then another key thing is actually that came into practice in Germany at the beginning of this year was the crypto custodian regulation. So also from that perspective is that usually in the traditional markets, we see custodian banks that take care of that. And that will also be implemented in the blockchain space. So again, more regulations that we need to make sure that we comply to when building platforms. Taxation is another part in the secondary market, can come in various facets, meaning that I can either go for an MTF license, so a multilateral trading facility that we know of exchanges, or I can start off with a bulletin system or bulletin board that will actually enable me at first to broker between two parties. And this is another key thing when we're looking at the conventional primary market is that we have an issuer and we have an investor. But what we can see here is there are a lot of intermediaries that take a cut into every transaction and make sure that it's actually validated. And the primary market on the blockchain is that I have an issuer, I have an investor, and I have some sort of platform for digital assets that will actually enable the issuer to reach out to an investor and vice versa, and just brokers the deal. And then obviously also make sure that token custody and management is being compliant. And the conventional secondary market, again, I have a buyer, I have a seller, I have a CSD, a central securities depository, I have a clearing system, I have custodian on both sides. So again, a lot of intermediaries, what we take from here. And through the secondary market on the blockchain, again, I just solely have the blockchain, I have a trading facility, and I have a buyer and seller. And then platforms can obviously, depending upon their stage, they can make sure that they provide some sort of net asset value towards the investors and other market maker structures that I briefly talked about before. Legal requirements, and this is one of the key things that I said, a lot of companies out there that operate in the blockchain space actually underestimate whatever they're bound by. So I obviously have financial conduct authority compliance, such as in Germany, the BaFin. I need to make sure, number one, I'm KYC, AML compliant, that's one thing. However, it also needs to be compliant to the Banking Act in the different countries, as well as depending upon the token structure, that they are still MiFID II conform, as well as the investment processes behind it. There is also a lot of GDPR compliance that's in this space actually. So we, for ourselves at Finexity, we reconciled with the German FCA for around a year and a half before we launched our platform to make sure that everything that we do is obviously compliant to the German Banking Act and MiFID regulations and so on. However, on the other hand, we also run on a private permission blockchain because we see really big GDPR issues that may arise in the future when it comes to the actual deletion of data that is on the blockchain. Another thing to consider is that it's transferable securities that we're talking about. In Germany, for instance, the transferable securities are obviously bound by MiFID II on a European scale, but we also have the security prospects law that we need to comply to, and the European prospects regulation. Just to make sure that everything that when we structure a security token, we make sure that the country we sell the token in, we are actually bound by their rules and regulations and make sure that we stick to those rights. Just a quick thing about our platform itself. As I said, we were founded in 2018 and we actually run 3 different models. We have a multi-asset investment platform for retail investors, simple investments that come from the RICS. We started off as real estate. We moved on to old-timers as well as art. We also duplicate that in the club deal space. All our investments are sourced through our partnerships, and what we really look for is that we look at the illiquid side of family offices and high net worth individuals, and make sure that we duplicate that for retail and other wealthier investors so that they can build the same portfolio and have the same asset allocation as family office when it comes to their private portfolio. Another thing is that we actually work with banks and other bigger financial asset managers that utilize our software to make sure that they are actually able to cover or cut their costs when it comes to the issuance. We offer tokenization modules and so on. So we're actually establishing an open banking system there. Thank you very much for your attention. And I would be really happy to talk to you about anything. Thank you.
Thank you very much, Paul.
Thank you.
You can hear me well?
I can hear you well, yeah.
Fantastic. Well, I see there are no questions in the chat. You still have a few minutes if there's anything you felt like you wanted to expand upon.
What I find really fascinating is that that the financial industry is actually changing towards a system where a lot of banks are opening up right now, where there is more asset managers that are looking for alternative ways to raise capital. And I think this is something that's really beneficial towards the space because actually blockchain does provide a lot of significant advantages that cannot be covered by traditional ways of raising capital. However, I believe that there will be some sort of consolidation in the market over the next 2 years with a lot of players, because I build platforms and just because every single platform tries to aim to get capital from the same investors and spend millions on marketing and so on, I don't think that this is the best way forward. So what I believe is that the financial system will actually move towards a marketplace that we already see in the e-commerce space, for instance. And this is where I really see the advantages of collaborating with other firms that work together. There's one. Are you looking for quality investment opportunities to share with your family offices? Yeah, sure. Always looking for new asset managers on our platform. Definitely feel free to reach out to me after.
That was very nice of you. Yes. Well, thank you very much. It was very informative and I enjoyed it a lot. So thank you for participating today.
No worries. Thank you very much.
Yeah. Have a great day.
Thank you.
Bye-bye.